Now, this week we're going to look at what is possibly in this year's budget, and is it an opportunity or is it a threat to us as property professionals? The budget, basically the government's annual roadmap for spending and taxation, it sets the tone for the year ahead, and when it comes to property and housing, the ripple effects can be massive going out there. Last year, Rachel Reeves raised 40 billion through taxes. People are still moaning about it now and saying how bad it is, and the potential ripple effect of that is huge in the longer term. This year, analysts warn further tax increases are inevitable unless the economy improves. There's an argument for increased taxes will not improve the economy. Many economists are saying that shouldn't be the case, and she's going the whole wrong way around it, but that's the way it is. Areas that we're looking at this year are stamp duty changes, new property taxes, inheritance tax reforms, capital gains tax tweaks, freezes on income tax thresholds, possible changes to personal savings ability with ISAs and so on, local authority funding and council tax overhaul. So let's look at each one in more detail. Stamp duty, what does that mean? Basically a new property tax. We've talked about it many times here on the wrap. It's a case of, should we go away from the UK version and across something like more Australian, US, Canada, New Zealand based, which is basically what they're suggesting is it's going to be scrapped on owner occupied homes and replaced with the tax paid by the seller when they move. Tax would only apply to homes over £500,000, starting at 0.54% and rising to 0.81% depending on the value. And that would affect about 20% of all property transactions. What does it mean? For landlords, buying additional properties may still attract the existing surcharge, but for the broader market could move differently as owner occupiers adjust. It's designed to make moving easier, and that's a good thing, because you need to be able to move house to go and get new jobs and get into new locations around the country without being penalised with a bad stamp duty. Okay, what's being explored next? Council tax overhaul. Now again, council taxes are stuck on valuations stuck in the 1990s, and so they're going to bring in new bands to reflect that. We don't know what they are, but I think that's pretty much a definite, and it won't happen immediately, but it will come in, and it'll affect most properties in the higher threshold areas. So that's definitely going to come in at some stage, and I think probably makes sense as well. Capital gains tax. CGT has already increased in 2024. Rates now 18% for basic taxpayers, 24% for higher or additional. What changes could be? The rates could rise, pay more tax. The £3,000 annual allowance could be cut again. And the worst one, potentially for many people, is going to be the mansion tax, which will be houses worth more than 1.5 million could face capital gains tax when sold. What does it mean? Anyone holding multiple properties should watch their CGT closely. Selling in 2026 could come with a higher bill. High-end markets could be a threat. Investors need to just think a bit more clearly about what they're doing. So mansion tax, that's going to be potentially a big thing. IHT, freeze the threshold. It hasn't gone up since 2009. Potentially could not go up again. And that is in reality increasing tax by stealth. Could be changed as a 7-year rule on gifting, perhaps increasing it to 10 years. There's lots of little taxes out there, but overall, are there lots of bad taxes that could come in potentially at this budget? Not specifically, I don't believe, which will have a specific negative effect on the property economy in the UK. Looking at the broader picture, it's more of gone from a wealth tax, not a wages tax in the UK. So it's people being taxed on their overall wealth and how much money they've built up, not on what they're earning at the moment. What does that mean for 2026? I mean, what everyone wants to know really is, how does it look for us as property potential investors? The foundation, as I said earlier on, for a healthier property market lies in a stable economy. As inflation continues to cool, that is what's coming through to purchasers. Okay, that'll have a direct effect on mortgage affordability. People are seeing that the economy is more stable. Interest rates are generally trending downwards, and by mid-2026, most of the pundits out there are saying we should have at least another couple of cuts, perhaps below 4%. So overall trend is stability, consistency, and hopefully nothing too radical on the horizon. Certainly the taxes that are coming in potentially don't seem that radical and won't be that bad a situation, but it just gets people worrying unnecessarily. But what about regional? The taxes we've talked about are mostly on high net worth people, which are going to be London and the South East. So property prices in London, £1 million. Property prices in Leeds, £400,000. Property prices in in parts of Derbyshire, £200,000. So it's the places where the most expensive property are that are going to be hit. So it's a very diverse market we're looking at. London and South East could suffer because of that. However, most compelling opportunities, outside the capital, places like the North West, Midlands, Yorkshire, they're projected to outperform the national average, driven by regeneration schemes, improved transport links, and expanding employment hubs. Cities such as Manchester, Liverpool, Leeds continue to deliver some of the UK's best rental yields, whilst also offering strong long-term growth potential. These markets offer the opportunity: transport, infrastructure, and employment growth. Transport growth, infrastructure growth, employment growth. If you have those sort of things going on, you're going to get a good market. If you can't get an extra motorway to be built, or an extra infrastructure built because of the congestion you've got in the southeast, that's a real problem. So those rental yields in those locations, regional variations are of strength. Look to those sort of locations. And then finally, the rental market and buy-to-let opportunities. It's going to remain one of the strongest areas of the property market in 2026. Many potential buyers postponed home ownership because of these higher rates, so they haven't bought as much. So consequently, they will be continuing to rent, which is going to put more pressure on the rental market. Immigration is going to be down probably to 250,000 people next year, with all the different cuts in qualification that are coming in. So that won't have a particularly large effect. The government, according to the Office of Budget Responsibility, is not going to hit its target of building all those houses within 5 years, and it'll still carry on into their next term if they get one. They're saying perhaps a 200,000 to 300,000 number of houses shortfall, because the underlying fundamentals in the market are not there. You haven't got enough people who can build properly. You haven't got enough available staff to build these places, and it's still too expensive to import a lot of the goods we used to import cheaply prior to Brexit. So existing landlords, 2026 presents an ideal opportunity to refinance at a lower cost, release equity, expand portfolios before prices climb even further, which they will. For new investors, the current phase of stability and improving affordability provides a strategic entry point into a maturing market. With rental demand continuing to exceed supply, yields are expected to remain robust even as property prices rise. For investors with a medium to long-term look, 2026 sets to deliver a rare blend of capital growth potential and rental income stability and favourable financing options. That's what we're looking at in 2026. Capital growth potential, rental income stability, there's still not enough properties out there, favourable financing conditions. And that, as investors, is what you should be looking at. So is it a good thing, the budget, or a bad thing? It doesn't seem that frightening, really. Where will be good places to buy in 2026? Caveat emptor, do your research, make sure what you're looking at is something you're comfortable with. Look at pies, population growth, infrastructure growth, employment growth. Look at ties, transport growth, infrastructure growth, employment growth. Look at those areas and look at value for money, and also make sure you're not paying too much in any charges to manage properties. It should be no more than 10% to manage a property from the fixed cost perspective. Back in the day, you used to have ground rent and service charges and everything else, and it could be up at nearly 30%. And I've got clients who are still paying that now, who can't get out. No more than 10%. So look for a good place, caveat emptor, make your buying decision wisely. Thank you very much. Stuart Williamson, Market Roundup.